You know that feeling when you get your pay slip and the numbers just don't add up the way you thought they would? Yeah, we've all been there. You do the mental maths in your head, think you're going to have a decent chunk of cash hit your account, and then reality smacks you fair in the face. Tax does that to you. But here's the thing, mate, it's about to change again. And if you're not across what's coming down the pipeline for the 2026 to 2027 financial year, you're going to be in for a bit of a surprise when July rolls around. Now, I'm not here to bore you with spreadsheets or talk like some parliamentary budget briefing. What I am here to do is break down exactly what these new tax rates mean for you in plain English, with real numbers, real scenarios, and no fluff. Whether you're working full-time, running your own business, doing a bit on the side, or you've already hung up the boots and you're living off your super and the pension, this affects you. Because let's be honest, most of us don't have a clue what we're actually paying in tax or what we're entitled to until it's too late. And by then, you're either scrambling to make sense of a refund or trying to figure out why you owe the ATO money you didn't know you had to cough up. So chuck the kettle on, settle in, and let's talk dollars and cents. Right? So first things first, the Australian tax system isn't exactly simple, but it's not rocket science either, once you know what you're looking at. Every year, the government sets income tax brackets. Basically, different chunks of your income get taxed at different rates. Earn more, pay more. That's the gist. But the brackets shift, the thresholds change, and every now and then the pollies decide to shuffle things around in the name of tax reform, or cost of living relief, or whatever's polling well that month. For 2026 to 2027, we're looking at another round of changes. Some of them are leftovers from previous budgets, some are new proposals that have been locked in, and some are still being argued about in Canberra as we speak. But the ones that matter most to everyday Aussies, the ones that'll actually hit your bank account, are pretty much set in stone now. Let's start with the brackets themselves. If you're earning under $18,200 a year, you're still in the tax-free threshold. That means the first chunk of your income, up to that magic number, gets taxed at 0%. Sweet as, but here's where it gets interesting. Once you start earning above that, you move into the next bracket, and this is where the 2026 to 2027 changes start to bite. For income between $18,200 and $45,000, you're looking at a tax rate of 19%. Now that's actually stayed pretty consistent, but what's shifted is the next bracket up. From $45,001 all the way up to $135,000, the rate used to sit at 32.5%. Under the new system, that's been flattened a bit. You're now looking at a 30% rate across that band. Doesn't sound like much, but when you're pulling in 60 or 70 grand a year, that 2.5% difference adds up to real money over 12 months. Above 135 grand and up to 190,000, you're paying 37%. And anything over 190,000 gets hit with the top rate of 45%. Again, not massive changes at the top end, but for middle income earners, which is most of us, that 30% bracket is where the action is. Now, before you start thinking, sweet, I'm going to be rolling in it, hold your horses. Because tax isn't just income tax, there's also the Medicare levy, which is 2% of your taxable income for most people. Then there's the Medicare levy surcharge if you're earning over a certain threshold and don't have private health insurance. Then there's HECS, or help debt repayments if you went to uni. Then there's superannuation, which isn't a tax, but it does come out of your pay before you see it. Oh, and depending on your situation, there might be child support, salary sacrifice arrangements, or other deductions in play. See what I mean? It's not just about the headline tax rate. It's about what actually lands in your account every fortnight or every month. And that's what most Aussies really care about, not the theory, the reality. Let me give you a real-world example. Let's say you're Sarah. You're 32, you work in admin, and you're earning $65,000 a year. No HECS debt, no private health dramas, just standard PAYG tax and Medicare levy. What's Sarah actually taking home? First, we calculate the tax. On the first $18,200, she pays nothing. On the next chunk from $18,200 up to $45,000, she pays 19%. That's about $5,092. Then from $45,000 up to her $65,000 salary, she's paying 30% on that $20,000 slice. That's $6 grand. So her total income tax is around $11,092. Then add the Medicare levy, 2% of 65,000 is 1,300. So total tax and levy comes to $12,392. Subtract that from her gross salary of $65,000, and Sarah's taking home $52,608 a year. Divide that by 26 fortnights, and she's pocketing about $2,023 a fortnight before super. Not bad, but also not exactly 65 grand, is it? That's the gap people don't always see coming. And if Sarah got a pay rise to 70,000 next year, she might think she's 5 grand better off. But in reality, after tax and Medicare levy, she's only taking home an extra $3,400 or so. Still good, but the tax system takes its slice. Now let's flip the script. Meet Dave. Dave's a tradie, runs his own small business, pulls in about $95,000 a year after expenses. He's also got a HECS debt from a course he did years ago. His situation's a bit different. His income tax on 95 grand works out to about $21,700, plus Medicare levy of $1,900. But then his HECS repayment kicks in. At $95,000, he's over the threshold where repayments start, so he's paying back about 4.5% of his income. That's another $4,275 gone. So Dave's total deductions are around $27,875. He takes home $67,125. Spread over the year, that's about $2,581 a fortnight. Dave's doing all right, but he's also losing nearly 30% of his income to tax, levy, and HECS before he even sees it. These examples show you why it's so important to know your real take home, not just your salary. Because your lifestyle, your savings, your mortgage repayments, your ability to go on that Bali trip, all of that is based on what hits your account, not what's written on your contract. And here's the kicker. A lot of Aussies don't realize they can actually reduce their taxable income legally and keep more of their cash. Salary sacrificing into super is one way. You divert some of your pre-tax income into your super fund, which gets taxed at 15% instead of your marginal rate. If you're paying 30% or more, that's a win. You're building your retirement and paying less tax now. Win-win. Then there's work-related deductions. If you're buying tools, paying for courses, working from home, traveling for work, or even just washing your uniform, you can claim that stuff back. The ATO's got pretty clear guidelines, and if you keep your receipts and do it properly, you can shave a decent chunk off your taxable income. That means a bigger refund at tax time, or less tax during the year if you vary your withholding. Another thing people sleep on is the low and middle income tax offset. Now that one's been a bit of a political football. It was supposed to end, and then it got extended. Now it's being phased out depending on who you ask and what month it is. But if you're eligible, it can mean up to $1,500 back in your pocket when you lodge your return. Not life-changing, but it's not nothing either. But let's get back to the 2026 to 2027 changes specifically, because that's what you're really here for. The biggest shift for most people is that flattening of the middle bracket. It means if you're earning between 45 and 135 grand, you're paying a bit less tax than you were under the old system. The government spun it as cost of living relief, and to be fair, it is a bit of extra breathing room. But it's not a windfall. We're talking maybe an extra $1,000 to $2,000 a year, depending on where you sit in that range. For someone on $80,000 a year, that's about $30 extra a week. Enough for a couple of coffees and a meat pie, sure. But it's not going to change your life. Still, in this economy, every little bit helps. Rent's up, power bills are cooked, groceries cost a fortune, and petrol's all over the shop. So if the tax system's giving you back even a modest amount, you take it and say cheers. What's also worth noting is that these changes don't exist in a vacuum. The tax brackets are one thing, but they interact with everything else. Super contributions, family tax benefits, childcare subsidies, pension eligibility, all of it. So if you're getting close to a threshold, sometimes earning a bit more can actually cost you benefits elsewhere. It's called bracket creep or effective marginal tax rates, and it can sting if you're not careful. For example, if you're a single parent earning $70,000 and you get a $5,000 pay rise, that might push you out of eligibility for certain family payments. Suddenly your raise cost you more than it's worth. That's why it pays to talk to an accountant or use one of those online calculators before you make big decisions about overtime, second jobs, or side hustles. Speaking of side hustles, let's talk about the gig economy for a sec. More and more Aussies are doing a bit of Uber driving, air tasking, freelance work, or selling stuff online. That's all taxable income, by the way. The ATO's got algorithms now that can see your bank transactions, match them with platforms, and figure out if you're earning cash you haven't declared. And they're getting pretty good at it. So if you're pulling in even a couple of grand a year from side gigs, you've got to declare it. Otherwise, you're risking penalties, interest, and a world of hassle. The good news is that if you're running a side hustle properly, you can also claim expenses. Your phone bill, your car, your laptop, advertising, all that stuff can offset your income and lower your tax bill. But you've got to keep records. Shoe boxes full of receipts might have worked in the 90s, but these days you want digital copies, photos, spreadsheets, the lot. Now let's talk about superannuation for a tick, because it's tied into all this. Your employer's got to pay super on top of your salary, currently 11.5% as of now, but it's creeping up toward 12%. That money goes into your super fund, and it grows over time. You can't touch it till you retire, but it's yours, and it's taxed way softer than regular income. Here's the thing, though. A lot of younger Aussies don't pay attention to their super. They've got multiple accounts from different jobs, they're paying multiple sets of fees, and their balance is getting eaten alive. Consolidating your super into one fund, picking a decent investment option, and maybe even chucking in a bit extra through salary sacrifice can make a massive difference down the track, like hundreds of thousands of dollars difference by the time you hit retirement. And if you're self-employed, you've got to sort your own super. Nobody's doing it for you. But the upside is you can claim your contributions as a tax deduction, which brings your taxable income down and saves you money now while building your future. It's one of the smartest moves you can make if you're running your own show. All right, now let's shift gears and talk about something that doesn't get nearly enough airtime. What all this means if you're retired or heading that way soon. Because the 2026 to 2027 tax changes aren't just about workers. If you're drawing down on your super, living off the age pension, or doing a bit of both, the tax landscape affects you too. And honestly, it can be even more complicated than it is for people still working. Let's start with the age pension, because that's the big one for heaps of Aussies. As of 2026 to 2027, the age pension rates are going to get their usual indexation bump. Nothing dramatic, but enough to keep up with inflation, sort of. For a single pensioner, you're looking at around $1,000 a fortnight, give or take. For couples, it's about $1,500 combined. Now that's the maximum rate, and whether you actually get, that depends on two things: the income test and the assets test. The income test looks at how much money you're bringing in from other sources. If you've got a part-time job, some rental income, or you're drawing money from your super as an account-based pension, that all counts. For singles, if you're earning more than about $200 a fortnight, your pension starts getting reduced, 50 cents in the dollar usually. So if you're pulling in an extra $400 a fortnight from work or investments, you lose $100 off your pension. It's a balancing act. The assets test is even trickier. It looks at everything you own. Your house doesn't count if it's your main residence, but everything else does. Your car, your caravan, your savings, your shares, your super if you're over pension age, the lot. For singles who own their own home, the asset threshold sits around about $630,000. Go over that, and your pension gets reduced. Go way over it, and you get nothing. For couples, the threshold's higher, around $950,000 combined. But here's the kicker. If you're just over the line, you might lose thousands of dollars a year in pension payments. So some retirees actually spend down their assets or restructure things to stay under the limit. Buy a better car, renovate the house, gift money to the kids within the allowable limits. There's strategies, but you've got to be careful because Centrelink's got rules about what you can and can't do. Now let's talk about super in retirement, because this is where the tax stuff gets interesting. If you're over 60 and you're taking money out of your super as a pension, it's completely tax-free. Doesn't matter if it's 10 grand a year or 100 grand a year, zero tax. That's a bloody good deal, and it's one of the best parts of the Aussie super system. And there's always a but. You've got to be in pension phase to get that treatment. If your super's still in accumulation mode, the earnings inside the fund get taxed at 15%. Not the end of the world, but it's not zero either. So once you hit preservation age, which is between 55 and 60, depending on when you were born, it makes sense to think about switching your super into pension mode if you're retiring or winding down. There's also this thing called transition to retirement, or TTR. If you're still working but you're over preservation age, you can start drawing a pension from your super while you're still earning a wage. The idea is you reduce your work hours, top up your income with super, and ease into retirement instead of just stopping cold turkey. The tax treatment's a bit different. Earnings in a TTR pension get taxed at 15%, not zero, but it can still be a smart move depending on your situation. Here's a real example. Meet Jan. She's 63, still working part-time as a nurse, earning about $40,000 a year. She's got 350 grand in super. She starts a transition to retirement pension and draws $15,000 a year from her super while still working. That 15 grand is tax-free because she's over 60. Her work income is still taxed normally, but because her total income's only 55,000, she's in a pretty low tax bracket. She's keeping more of her money, building her super balance with the concessional contributions from her employer, and she's got flexibility. If she wants to drop down to 3 days a week, she can top up the difference from her super without stressing. Now compare that to Bob. Bob's 68, fully retired, gets a part-age pension, and he's drawing 30 grand a year from his super. His super pension is tax-free. His age pension is also tax-free. Pensions aren't considered taxable income. So Bob's living on about 55 grand a year total, and he's paying zero income tax. He still pays GST on stuff he buys, rates on his house, all that, but income tax? Nada. That's the magic of retirement planning done right. But here's where people trip up. If Bob's got too much in his super, say he's got $1 million sitting there, he might not qualify for the age pension at all because of the assets test. So he's living entirely off his super. Now that's still tax-free, but he's missing out on the pensioner concession card, cheaper scripts, bulk billing, all the little perks that add up. Sometimes it actually makes sense to have less in super and more in other places, or to structure things differently. It's counterintuitive, but that's the system. There's also the Seniors and Pensioners Tax Offset, or SAPTO. This is a tax offset specifically for older Aussies. If you're eligible, it can reduce your tax bill by a couple of grand. You qualify if you're of pension age or you're getting certain government payments. The offset phases out as your income goes up, but if you're a single retiree earning under about 50,000 or a couple earning under 90,000 combined, you're probably in the zone. It's another thing most people don't even know exists, but it can make a real difference. Then there's deeming. This is how Centrelink calculates the income from your financial assets for the income test. They don't look at what you actually earn. They assume you're earning a set percentage, called the deeming rate. As of 2026 to 2027, the deeming rates are sitting around 0.25% on the first chunk of your assets and about 2.25% on the rest. Now, if you're getting more than that in reality, great. You keep the extra and Centrelink doesn't care. But if you're getting less, too bad. They still deem you as earning that amount and it affects your pension. It's a bit rough if you've got money sitting in a savings account, earning stuff all, but the rates are what they are. The upside is, it's predictable. You know exactly how much income Centrelink's going to count, so you can plan around it. If you're a self-funded retiree, meaning you're not on any government pension at all, then you've got a different set of concerns. You're living entirely off your super, your investments, maybe some rental income. The good news is, your super pension is tax-free. Investment income outside super might be taxable, but you can use strategies like franking credits to reduce or eliminate the tax. Franking credits are a refund of the tax the company's already paid on dividends. If your tax rate is lower than the company tax rate, you get money back. Retirees love franking credits. You might also be eligible for the Commonwealth Seniors Health Card if you're self-funded. It doesn't come with cash payments, but it gets you cheaper prescriptions and some other discounts. The income test for the card is pretty generous. Singles can earn up to about 61,000, couples about 98,000. If you're just over the age pension income threshold but still not exactly cashed up, the Seniors Health Card can be a lifesaver. One more thing retirees need to watch is the transfer balance cap. That's the maximum amount you can move from accumulation phase super into pension phase. As of 2026 to 2027, it's sitting at around 1.9 million. If you've got more than that in super, the excess has to stay in accumulation mode, which means the earnings get taxed at 15% instead of 0%. It's a problem most people would love to have, sure. But if you're in that boat, you've got to plan carefully. Estate planning's another big one. When you cark it, your super goes to your beneficiaries. If they're a dependent, like your spouse or a kid under 18, they can take it as a pension and it stays tax-free. But if it goes to an adult child who's not financially dependent on you, they cop a tax bill, up to 17% on the taxable component. That can be a nasty shock if your family's not ready for it. Setting up a binding death benefit nomination and getting proper advice can save your loved ones a heap of drama and dollars. All right, let's bring it all together. The 2026 to 2027 tax changes are real. They're happening. And they'll affect your take-home pay, whether you're working or retired. For workers, it's a modest benefit. A bit of extra cash each pay cycle, thanks to lower rates in the middle income brackets. For retirees, it's about understanding how super, the age pension, tax offsets, and Centrelink thresholds all work together to give you the best possible income in retirement. If you want to know your exact take-home pay or your retirement income, here's what you do. Grab your figures. Work out which tax brackets or pension thresholds you fall into. Calculate the tax, the Medicare levy, any offsets you're eligible for. Factor in your super pension, your age pension if you're getting it, any deeming income, the lot. That's your real number. That's what you're actually working with. There's heaps of online calculators that'll do this for you in about 30 seconds. The ATO's got one. Services Australia's got pension estimators. Money Smart's got retirement calculators. Punch in your details, and you'll get a pretty accurate picture of where you stand. And if your situation's complex, multiple income streams, investment properties, trust distributions, overseas pensions, whatever, then yeah, it's worth paying for proper advice. A good financial planner or accountant will save you more than they cost. Guaranteed. At the end of the day, tax and retirement planning are part of life. We all deal with it, we all wonder if we're doing it right, and we all stress about whether we'll have enough. But understanding how it works, knowing what you're entitled to, and taking control of your own financial situation, that's empowering. That's the difference between scraping by and actually enjoying your retirement, or between stressing every pay and having a proper plan. So don't just take the government's word for it. Don't just trust your employer's payroll system or assume Centrelink's got it right. Do the numbers yourself, know what you're entitled to, claim what's yours, and make sure that when 2026 to 2027 rolls around, you're not caught off guard. You're ready, you're informed, and you're getting every cent you've earned or you're entitled to. Because at the end of the day, it's your money, and no one's going to look after it better than you.